Hello, my name is Ian Larkins of Radius Law and welcome to our monthly commercial bulletin brought to you in association with LexisNexis. The Department for Business, Innovation and Skills, BIS, has produced new guidance on payment surcharges. The Consumer Rights Payment Surcharges Regulations 2012 prohibit traders in the UK from charging consumers more than the direct cost borne by the trader for the use of a given means of payment. The new guidance includes the types of costs which can be covered when applying a payment surcharge and how the regulations interact with other consumer legislation. When a court is asked to determine a contractual term that is in dispute, the court will often need to decide whether it applies a common sense or whether the words should take their literal meaning. The case of Arnold v Britton and others of 2015 concerned a service charge clause in a lease for a holiday chalets. The clause required the tenants to pay a £90 service fee, increasing by 10% per annum compounded. The tenants argued that although the wording was unambiguous, this was not the intention, as it would leave them exposed to an annual service charge of more than £1 million by the end of the 99-year lease. The Supreme Court, however, dismissed the appeal brought by the tenants. The court stated that whilst commercial common sense should be applied when interpreting contracts, this would not override the language used in the contract that was not ambiguous. Further, the court should not be responsible for saving the parties from an imprudent bargain or poor commercial decisions. The Information Commissioner's Office, the ICO, records show that it received 19,404 complaints about nuisance calls in June. That's an increase of 9.5% from the same time last year. The ICO is, however, keen to demonstrate that it is taking action to combat this growing problem and has reported that there were 59 nuisance call investigations running in June and 2 search warrants issued. One Bournemouth-based company, which marketed a device to block nuisance calls, has, ironically, been issued with a penalty of £50,000 after it was found to be responsible for large numbers of nuisance calls itself. The Claims Management Regulator, the CMR, which regulates companies that offer claims management services, is also taking action in this area. They have fined the Hearing Clinic £220,000 for making cold calls to individuals that were signed up to the Telephone Preference Service for TPS. Clearly this is a hot issue, and companies that cold call consumers or use agencies to cold call on their behalf are strongly advised to ensure that good data protection policies have been implemented, always ensuring that call lists are being cross-checked with the TPS. The ICO has issued a £180,000 penalty to the Money Shop after the company lost computer servers containing details of several thousand customers. In 2 separate incidents, one server was stolen and another server was lost by a courier firm. Whilst these incidents may not have been avoidable, the ICO identified that the Money Shop's controls and processes were insufficient. In particular, neither server had sufficient encryption systems for the company to be confident that the information they contained could not be accessed. The ICO also expressed concerns that although the company had a procedure for the servers to be stored in a locked room, they found that some of the branches did not have separate rooms that could be used in this way. The ICO has issued updated guidance on one of the most commonly used exemptions under the Data Protection Act 1998. The crime and taxation exemption. Many organisations receive requests for personal data from law enforcement agencies and sometimes from insurance or private investigation companies citing this exemption. It is often misunderstood as an obligation for companies to release personal data, where it is actually an exemption in limited circumstances to release personal data without the consent of the person that the data concerns. The guidance includes live examples to illustrate various scenarios. The case of Coles v Ministry of Defence confirms that the Agency Worker Regulations 2010 does not provide a general right for an agency worker to be treated less favourably. The rights of agency workers under this legislation are specific. This case highlights that although there is usually a right for an agency worker to be informed about vacant posts, this does not apply if there is a genuine headcount freeze, where posts are ring-fenced for internal candidates to avoid redundancies. The regulations also do not extend to applying any special treatment for the agency worker. The employer may, for example, apply a time in service or experience qualification. Childcare vouchers have been a popular scheme, allowing employees to pay for childcare from a pre-tax salary. This has proven to be a win-win system for the employer and employees, as the employer can also make an NIC saving and of course be seen as providing a valuable benefit to its employees. There has, however, been a lack of clarity concerning whether childcare vouchers are classed as remuneration or a non-cash benefit. This has important implications for employees who are on maternity leave, as the employee will be entitled to the non-cash benefits of her employment but not remuneration, as this is replaced by statutory maternity pay (SMP) or the employer's contractual pay scheme. The HMRC has provided guidance that childcare vouchers under a salary sacrifice scheme are non-cash benefits. As the employee will often not be receiving a salary during maternity leave, this then leaves the employer to fund the vouchers itself. An employment tribunal has now also considered the issue and agreed with the HMRC guidance. The employment tribunal case concerned an employer scheme that required the employee to opt out of the scheme when on maternity leave. The tribunal ruled that this practice constituted sex discrimination. The Consumer Rights Act, the CRA, will be enforced from the 1st of October. The Act consolidates and enhances existing consumer law, including unfair contract terms. The Competition and Markets Authority, the CMA, has now produced new guidance to assist businesses with understanding what makes terms and notices unfair. There is something for everyone, with 3 levels of guidance: short 2 pages, expanded 28 pages, and a full version at 144 pages. The one-line summary, however, is that businesses should deal openly and fairly with consumers and not use terms that they would not sign up to themselves. Some of the other headline points in the CRA include consumers to have a new 30-day right to reject faulty goods and obtain a full refund from the later of a date of purchase or delivery. Alternatively, consumers can allow businesses a one-time chance to repair the goods. The 30-day period is paused if the consumer opts to ask for the goods to be repaired. There are new remedies where digital content damages a device or other content, and this may include repairing or compensation. The Spanish Competition Authority, the CNMC, has fined automotive manufacturing companies and 2 consulting companies for anti-competitive practices. The fines totalled €171 million. The case concerned information exchanges between 2006 and 2013. The CNMC reported that the information exchanges included sensitive future information which was highly disaggregated. This dampened competition and ultimately consumers suffered, as there were less aggressive practices in the marketplace. The Volkswagen Audi Group escaped fines of almost 40 million by reporting the practices. Last month we reported on the Modern Slavery Act. In particular, this Act places an obligation on certain commercial organisations to prepare a slavery and human trafficking statement each year. At the time of our bulletin last month, the government had not announced which organisations would be subject to this requirement, but they have now confirmed that it will apply to organisations with a turnover of at least 36 million. This is a threshold set out in the Companies Act 2006 for determining the size of a large company. The government intends to introduce this legislation in October and will introduce statutory guidance. We will be keeping a keen eye on developments here and will report on the guidance as soon as it is available. The Financial Conduct Authority, the FCA, has initiated a review into how staff are incentivised to sell financial products. This follows some work undertaken by the FCA between 2012 and 2014, which found that many businesses' incentive schemes were likely to drive mis-selling. One example being that managers received a bonus based on the sales made by the staff that they supervised, creating a possible conflict of interest. The FCA's review and report should be completed by early 2016. Thank you for joining us for this month's Commercial Legal Bulletin. We create a video, podcast and a newspaper each month. All are available on the LexisNexis blog. Subscribers are the first to receive the latest news alert. Enjoy the rest of your summer. Until next month, goodbye.